RPGT last week, so let's look at questions with RPGT. Page 99, 99. Okay, it's a 15 marks requirement on RPGT. The first part, it says assuming that both the properties have subsequently disposed of by the children, determine what's the acquisition price and the acquisition date of the properties transferred to the son, the daughter. Okay, just simple 4 marks requirement. Okay, now they say Alex owned 2 property, a bungalow in Bangsa and a shop lot in Shah. Now the bungalow was acquired on 19 April 2009 for 100,000. and the shop lot was purchased for 150,000 on 14 February 2010. So on 1st of May 2011, Alex gifted the bungalow to his daughter. So gifted to the daughter, at the market value of the property was 170,000. Now on 5th of May 2011, he sold to his son the shop lot for 150,000, although the market value at that date was 175. Okay, so there's 2 issues here, right? Okay, one is a gift, one is you sell. Correct enough? This is June 2002. 2012. Okay. So if you look at A, now daughter is what? A gift. So if it's a gift between parents and child, what kind of transaction is that? No gain, no loss. And no gain, no loss, what's the rule when it comes to the acquisition price and acquisition date? You acquire at what? You didn't buy, right? Correct enough? Huh? The daughter didn't buy. So if the daughter didn't buy, then will the daughter get an acquisition price? Yes. The acquisition price is what? Is the deemed consideration paid. Correct enough? Which is how much the parents, the father paid, okay, plus the PE, and then transfer it to you. And obviously you minus off your recovery if you have, but this is a very simple example, there's no other figure. So in that case, the price to the daughter will have to be the price of the father, right? That's the only figure we have, correct enough? So how much is that? 100,000. And what's the acquisition date? The date you acquire is the date of the transfer, which is 1st of May 2011. Okay? Now, gift is a no gain, no loss. This is just a note for you all to know. Okay, to the son. What's the issue now with the son? The son is you sell the shop lot. Correct? You sell the shop lot. So if you sell the shop lot for 150,000, the market value is 175. So when you sell to the son below market value, what's the issue? Dispose to your connected person, not at arm's length. The price is at bargain. It will be deemed disposed at market value. Okay, so this is where there's a disposal at a bargain to connected person. So it will be deemed disposed at market value. So when you dispose at market value, the acquirer will acquire at market value, right? So that's why the market value will be 175,000, and the date of the acquisition is 5th of May 2011. Sorry, huh? That's why if you have a property that you want to transfer to your child, okay, that means between parents, child, okay, husband, wife, grandparents, grandchild, if you want to transfer, if it's already more than 5 years, you don't transfer for free, you sell. You can sell below market value, you know, because when you sell, then you will deem dispose at market value. If you dispose at market value, the acquirer will receive at market value. Agree, no? Which is good for the acquirer, right? Because you think and see, the son buy at 175, which is good one, because next time when the son sell, his cost is higher. And since the property is more than 5 years, you will be exempted. If you give it as a gift, even though more than 5 years, it will still be no gain, no loss transfer. Then the value that your son or your daughter receive the property is very low already, because it's based on your original cost. You see, no? So that's a bit of the idea, I'm explaining over here. Okay, now that's A. That's it. Done already. B. Okay, now due to the financial constraint, Pauline had to dispose of the land which she owned in Seremban on 1st June 2012 for 350,000, and the land had been acquired on 15 June 2009 for 230,000. So work out how much is the RPGT that she is liable to. Okay, now this is very straightforward because there's no other figure. So first, the date of disposal is 1st of June 2012. Okay, date of acquisition is 15th of June 2009. And which year is that? So you count, June 10, June 11, June 12. Now this is 15. So this is sold on the 1st. So it's before or after? Before, right? That means how many finger? 3. So this is in the 3rd year, where the rate is how many percent? 20. Oh. Okay, the rate is 20. Alright, now what is the disposal price? See, the examiner is not testing you what is in disposal price, because she just give one figure. You sell it for 350. That has to be the disposal price. Okay, what's the acquisition price? 230. So you get this as your chargeable gain, which is 120. Okay, once you come to chargeable gain, I forgot to put YA, sorry, YA 2012 you dispose of. Okay, once you come to chargeable gain, then what do? Schedule 4 exemption, yes, because this is an individual, which is based on 10% of the gain, or 10,000, whichever higher. So the higher is 12,000. Okay. So 108. And what do you do after that? There's another exemption. Okay. Now, so the exemption will be 108 times 100%. What's the rate you're going to use? 20, right? 0.2 ma. Minus, what's the rate you're going to use? 0. What's the effective rate if you dispose in the third year? 15. First 2 year is 30. Third, fourth, fifth year is 15 or 10? 10, sorry. Okay? Right. So divide by 108 times 0.2 times 108. So you get 54,000. So 54. Your RPGT will be 10,800. Okay, move on. Okay, now B, C, they say state any 4 circumstances whereby transfer will be deemed to be no gain, no loss. Give me 4. A gift between husband, wife, parents, child, grandparents, grandchild. Please write properly, don't write PC. Okay? This is the basic one that we always see. What else? Give to government, state government, local authority, or a tax exempt charity. There's another easy one to remember. Okay, some more. If let's say there's a person who passed away, right? So devolution of asset of a deceased person on his executor or legatee. Or you just write, you don't write so technical, you just write a transfer of asset from a deceased person to beneficiary, we also mark for it. Okay, as long as we can see the point there. Number 4, the part that we say if you transfer by way of security. Okay, so conveyancing or transfer by way of security. These are all considered as no gain, no loss. Just write any 4. Okay. Now, so in the law, this is 1. Okay. In the law, this is 1. So I think it's not so nice because in the exam we may not give you repeating marks, and because some students they're very smart one. They don't know what are the 4. So what they do, they say give between husband and wife, give between parent and child, give between grandparent and grandchild. Then they say, wow, see, I got 3 answers. Okay. Now depends I really say depends. In the exam, if that is given as separate point, then you get separate mark. But if examiner official answer is all that is 1 point, you write 3 times is also 1 point. Okay. So you are not cheating the examiner or the marker. You're just cheating yourself only. Okay. Now look at the last part, B. Explain how the date of disposal is determined if there's no written agreement. How do you determine? If there's no written agreement, it's always based on the earlier of full payment or transfer. Okay. Now, if there is no written agreement, date of disposal shall be the earlier of the receipt of full consideration or the date of transfer of ownership to the acquirer. Okay, all right, so that's questions on RPGT. Okay, now let's move on and look at one more in the following exam. Okay, now please turn to page 111. Okay, see question 5. This is just 10 marks. Alright, now in October 2009, Raja acquired a piece of land in Malacca for 600,000. Thereafter, he incurred 180,000 in fouling and raising the land to prevent flooding. On 3rd of December 2012, he sold 1/3 of his land for 2 million. That's it. Calculate the gain that is subject to RPGT. Now you don't need to calculate the tax, and you don't need to compute the gain based on the holding period or to take into account the exemption. That means you just calculate until the gain. You don't need to show how much is the exemption that is based on the strange formula that depending on how many years you hold. Okay, so that's it. Okay, 4 marks. Now you try this. Okay, try this. So the issue I want you all to take extra care here is, this is a land. You only sell 1/3. That's the part I must remind you. Okay, try this. Now, first, to work out the disposal price, the date of disposal is 3rd of December 12. Date of acquisition is October 09. That's which year? 10, 11, 12. Okay, so until October is 3 years. This is December, right? So you must add one more year. So that's the 4th year. 4th year is at, what's the rate? 15, right? Okay, this is YA 2012. Okay, disposal price. Now, consideration is 2 million. What do you do after the consideration? You minus 3 things, which will be enhancement, incidental, and defend title. That's the 3 things. So in this case, there's only one thing, which is enhancement, because they spend money to raise the land to prevent flood. Okay, so the enhancement cost is how much? 180, right? But can you take 180? You can't. Why? Because 180 is for the whole thing. Okay, so now you only sell 1/3, which I presume the 180 is for the whole piece. So if you sell 1/3, the enhancement cost is just 1/3 of the cost. Okay, that's it. So my DP is 1940. Okay, what's my acquisition price? Now, my acquisition price is just my consideration. Just one figure only. There's no other figure only. Okay, is my consideration. Again, 600, you take 1/3. So 200,000. So you get chargeable gain as 1740. Now, do you get schedule 4? Do you get schedule 4? Yes or no? Who is this? Raja, right? Which is individual, right? You get schedule 4, right? Yes. But this schedule 4, do you get full amount? No. You get partial. Okay, last time don't have one, and now only the new law got. So you see the exam answer is different. Okay, so you get partial exemption. Now you still work out higher of 10% times 1.74 or 10,000, which is 174, and then your apportionment. Land sold is 2 out 1/3. That means assume it's 1 out of 3. The land size that you sell is 1 portion. Out of the total is 3 portions, so it's 1/3. So if you take 1/3 of 174, your schedule 4 exemption is 58. That's it. That's your answer. Okay. Right, now move on to part B, please. Okay. All right. Now on part B, they say compute Mark's gain subject to RPGT, stating clearly his dates of acquisition and disposal. Okay, Mark signed a sale and purchase agreement with the property developer to purchase a property for 580,000. Now, Mark incurred legal fee of 1,000 ringgit, stamp duty of 9,000 ringgit on the purchase of this property. Okay, on the 9th of October 2009, the developed property was duly handed to Mark by the property developer. Mark spent 50,000 on renovation. Now on 10th of November 2011, Mark verbally agreed to sell the house to his neighbor for 800,000. The neighbor settled the consideration in full on 10th of February 12, and the title transferred to the neighbor on the 2nd of December 2012. Now, they only ask you to state. They don't need you to explain, okay? So now you tell me what is the date of disposal. What's the date you sell? 10th of November, 10th of February, 2nd of December. Which one? Huh? 10th of February 2012. Why not 10th of November? Huh? Verbally. What's wrong with verbally? Say only. So? Say only cannot? Eh? Why cannot? Huh? Black and white, yes. It's not because it's verbal. The reason is not because it's verbal. The reason is because it's not written. Understand? Don't say because it's verbal. You're not explaining. I ask you why cannot, because you say it's verbal. No. You cannot say because it's verbal. Because it's not written. Can see it or not? Okay? Because verbal is not the issue. Issue is not written. So explain the right thing. Okay? So it's not a written agreement. So it must be based on written. If you don't have, then only you use the earlier of payment or transfer law, which is 10th of February. So what's the date of acquisition? 12 of February 2009, right? Because there's a written agreement. So which year is that? 10, 11, 12. So third year, right? You buy in February 12 ma. So February 12 to February 12 2010 no? 2011 no? 2012 no? Until 12 ma. This is 10 no? It's still before, right? So it's in the third year at 20%. Okay, this is Y2012. Okay, so what is my disposal price? How much is the consideration paid? You sell for 800,000. What else you adjust? Okay, you look for P, which is enhancement, defend title, incidental cost. Now so far we see there is enhancement, right? The enhancement is in the form of renovation, which is 50,000. Any defend title? No. Any incidental cost? Also no. Okay, just one thing only. So in that case, disposal price is 750. Okay, we minus the acquisition price. So the consideration is 580. Now you usually add incidental costs on acquisition. You have that? Yes, sir. The incidental cost on acquisition is 1,000, 9,000. So it's 10,000. Okay. So 590. Do you have recovery? Deposit forfeited compensation? Okay, don't have, so my AP will be 590. So my chargeable gain is 750 minus 590, which comes to 160. You get schedule 4. So schedule 4 is 10% of 160 or 10,000, whichever higher. So 16,000 is the higher. So 144. Now you don't need to calculate the tax and don't need to calculate the gain based on the holding period of the exemption. That means you just need to stop here. Okay. So a lot of students in the exam very funny one. They calculate all the way until the end. Okay, probably too much time. Alright, so done with this question 5. Okay. So one last RPGT question. Because RPGT is a new thing. Okay, so you only see them tested back recently. Okay, if you look at page 121, okay, right, this is the requirement. Okay, explain the RPGT implication on the gift of land from Esther to Yi on 1st of March 2012. And then compute the chargeable gain arising from the disposal of the land by Yi to Zen on the 6th of February 2013. Clearly identifying the disposal price and the acquisition price of the transaction. Now you are not required to compute the RPGT. You are not required to compute the chargeable gain based on the holding period or take into account the exemption based on the holding period. You should indicate with the word nil that you refer to any item where no adjusting entries are made. Okay, so we're going to do the A and B first. Okay. Now on the 12th of January 2010, Esther acquired a piece of land for 2 million, paying stamp duty of 50,000 on 1st March 2012. Now Esther transferred the land to her husband Yi without any valuable consideration. So his wife transferred to her husband. Okay. And Yi immediately built a storage building for 490,000 on the piece of land. Now in September 2012, Yi received an offer from ACCA to acquire the property and receive a deposit of 10,000, but the company subsequently decided not to pursue, and now deposit is forfeited. On 6 February 2013, Yi disposed the land for 3.5 million to Zen, and Yi incurred 10,000 on the valuation fee. Okay, so the first thing is the implication. Now what is the implication when you transfer? What is that? Again, it's no gain, no loss, right? But please don't use the word no gain, no loss. I've said to you all before. Okay. Now, the gift between husband, wife, grandparents, grandchild, parent, child would be deemed to be at disposal price equals to its acquisition price, giving rise to no chargeable gain. So Esther is not liable to RPGT. Okay. Now then, to Yi is deemed to acquire it at Esther's acquisition price plus PE, permitted expense. Okay. on the date of the transfer. Okay, now that's it, part A. Explain the implication. Now do B for me. I put down the date first. What's the date of disposal? 6th of February 2013. And the date of acquisition? 1st of March 2012. Okay? Okay. Within 2 years at 30%. So Y2013. Okay, so first you get what's the disposal price? T 是 per， T per meter expense。进来啊，没有读过。Okay, the consideration, how much? 3.5 million. And then you minus, okay, three things enhancement, defend title, incidental. Now got enhancement or not? Did the husband spend anything to upgrade? Which one? Storage. Okay, so the enhancement cost, the storage building, $490. But the defend title don't have. Incidental cost gone up. Which one? The valuation. Okay, that's to sell, right? That's why incidental cost on disposal amount is 10,000. That's it. So disposal price is 3 million. Okay, the acquisition. She didn't pay for it. So we're going to work out what's the deemed consideration paid. Now the deemed consideration paid will be Esther's AP plus P. Okay, what's Esther's AP? She paid how much? 2 million. So consideration paid is 2 million. And she got incidental cost? Yes. So the incidental cost is 50. So that's 2050. Okay, then you minus recovery. Any recovery? The recovery is not Esther. The recovery is the husband. Okay, so this is the AP. Now got PE or not? No PE also lah, huh? Okay, the husband didn't, the wife didn't incur any PE. So 2050 is deemed consideration paid. Okay, now then he received deposit forfeited, which is 10,000. So the acquisition price is 2040. Right, the gain is 960. So again, schedule 4 exemption will be 10% of 960 or 10,000, whichever higher. So the 10% is higher. So the gain is 864. Now if you going to tax this guy, what's the effective rate you will use? What's the effective rate? First 2 year is 20, right? First 2 year is 15, right? Sorry, I also can't remember. Don't blame me. Examiner changed, the government changed too many times until I also blurred. Effective rate for first 2 years. It's 15, then 10. Okay. So if you're going to work out the exemption, then you must take the gain times 0.3 minus the gain times 15. So you just show, but don't need to show, okay? So if just in case they ask you to calculate, that's what you do. Alright, now look at the last part. Okay, C, they say Yi has received an offer from his brother-in-law for a shop lot acquired on 10th of July 2008. He is considering accepting the offer and disposing of the shop lot on 28th of June 2013. Okay. So who is buying? Who buy from who? Brother-in-law buy from Yi. Yi receive an offer. People offer you. That means you are selling. Understand not? Okay. So Yi is the disposer. Brother-in-law is the acquirer. Okay. Now advise Yi as to how he can minimize his exposure to RPGT, taking into account the holding period of the shop and the effective tax rate which would apply. Okay, so if you look at this situation, you calculate and see which year will the disposal be. If disposed on 28 June 13, and you acquired on 10th of July 08, okay, let's calculate and see 9, 10, 11, 12, 13. Correct? Not? This is June, right? So until 13. So which year is that? 5th year. Is disposal in the 5th year after acquisition. So the RPGT is taxed at an effective rate of 5%. So, how do you propose to minimize his exposure? You just have to delay, right? Correct or not? 5%. Okay, it must be 5, it cannot be 10, because after the exemption, your rate is at 5%. I explained that last week. Okay, because your gain minus the exemption, you times 5%. So this exemption, if you take the gain times 5% minus gain times 10%, you're going to get 0. So that's why the exemption will be 0. So once the exemption is 0, you still get back 5%. So it's not 10. Okay? So the effective is 5%. Now, how do you minimize your exposure? What do? You delay, right? You delay by how long? Don't even need 1 month, right? Because you acquire on the 10, you just delay until you dispose after 10. You see now? Okay? Now you delay the signing of sale and purchase agreement to after 10th of July 13, so that it is a disposal more than 5 years, or in the 6th year. Okay? Where chargeable gain is exempted from RPGT. Okay, that's how you do it. Alright, so that's all on the RPGT questions available. Okay, right, let's move back to another issue. Now I would like you all to look at page 109. Okay, questions on CA. Now, the requirement A, there it says that compute the residual expenditure and the balancing allowance or the balancing charge on the disposal of the four-wheel drive vehicle. B, compute the capital allowances available on the remaining qualifying asset 109. Okay, compute the CA available on the remaining qualifying asset for Y 2012, clearly stating the qualifying expenditure for each asset, and then explain what's the income tax treatment of the payment made for the truck under the lease financing arrangement. It's a lease. Okay, alright, read. Jones and Ram Berhad is a trading company which makes up their account annually to 31st December. Now below are details relating to the fixed asset of the company. Okay, number one. In November 2009, Jom acquired a four-wheel drive vehicle for use by the general manager. Now the hire purchase terms, the cost is 200,000. The down payment is 20. The hire purchase loan, which is the principal sum repayable in 10 equal installments, commencing in December 2009, is 180,000. Now the four-wheel drive vehicle was then disposed in June 2012 for 20,000. Okay. Now in January 2011, the company purchased a car called Motor Car, cost 240,000 for the use by the Chief Executive Officer. The amount will be settled in 12 installments, commencing in February 2011. And the delivery truck was acquired in 2011 under the finance lease. It's a lease. I don't care what lease. Lease is just a lease. Operating or finance is only an accounting concept. In tax, we call it lease. What is lease? Rental agreement. That's it. Okay? Now, and they use it in the trading business. The amount paid for the lease payment is 170,000, 30 of which paid in 2011, 100,000 paid in 2012. Now in August 2012, a new car, which is Motor Vehicle 2, was acquired for cash 148,000 and used in trading business. Now other additions of fixed asset in 2012 include a closed CCTV system and 10 units of filing shelf at the price of 690 each. Okay, so first of all, examiner just focus on the four-wheel. Work out the RE, the BA, BC when you dispose the four-wheel. Now that means you're going to start right from the beginning. Okay, how much you claim, work out the RE, then you work out the disposal. Okay. This is December 2012. A. Is the four-wheel vehicle commercial or non-commercial? Commercial or non-commercial? It's a non-commercial vehicle, right? Because it's used by the general manager. It's not for purpose of carrying goods or what. Okay, so it's non-commercial. Alright, now this is hire purchase, correct? No? So hire purchase, you will have to split into different payment. So you start in November, December is the first payment. That means you will go from 09 to 2010. Okay, so QPE incurred in Y09, Y 2010. Okay, so the down payment I just show here lah, is 20. Okay, put in the capital repayment. So you know how much is the QP. Now, I've solved the major steps for you already. You just fill in the capital repayment QP, then you start calculating the CA. Claim until the year you want to dispose, then you work out how much is the disposal value, and then what's the BABC. So how much is your capital repayment? 180,000 you pay by 10 installment, so it's 18,000 one time. How many months do you pay in 09? You start in December, so 1 month, okay? So 1 month. Then how many more months? 9, which means 18 and 162. Okay, so why 2009 you claim IAAA? Vehicle is 2020. Sorry, forgot one important thing. The amount must restrict to maximum 12 because the cost of the vehicle is more than 150,000. Okay, so you must restrict to 50. So it's just 12,000. Alright, so 38 times 20% is 7676. So this is the CA you claim. So the RE will be 22.8. Okay, why 2010 you claim AA and then you claim IAAA for the amount in 2010. So 2004 and then 10,000. So your RE will be 15,002, 7,002. Now why 2011 you only claim AA, which is 76, 2004 So your RE is 76 4008. Okay, now there will be a disposal in Y 2012. What's the disposal value? They say they sell the vehicle for 20,000, but 20 is the full amount, right? You adjust by multiplying 50 out of 200. So the value is restricted now to 5,000. Now the residual expenditure is these two amounts. 76 plus 48 is 12,004. So minus 5,000. So now we get a balancing allowance in Y 2012. Okay? Alright, so that's the first part A, 7 marks. Okay, now we look at the second one. Now, second one, they just say compute the CA available for 2012, and you have to state clearly the qualifying expenditure. Now, they are asking for 2012 only. You don't calculate 2011 also, never mind. Okay, you can straight away calculate 2012, and you state what is the qualifying expenditure and what kind of allowance you get. Alright, now one thing I must warn you is note 2. Now the question say that they buy a car for 240,000 that they will settle in 12 installment. Now you must understand that 12 installment is not hire purchase. They didn't say it's a hire purchase. Now, hire purchase is a very specific treatment we give in the law. That the reason why you must calculate the amount into different period and you claim according to the amount is because this is a hire purchase. Now, if you want to buy an asset and the actual timing of payment is not important, correct? Let's say, for example, this is a machine. Okay, this machine I buy from you in December. Okay, so you send me the machine now. But I only settle you the bill in February next year. So can I start claiming CA? Even though I only settle next year? Can what? Because we don't follow timing, because we say incurred means when it become available for you to use. Can you know? The only thing that you look at the timing is hire purchase. So this second, the car number 1 is not very nice because examiner used a 12 installment. So many students thought that this is hire purchase. Now it's not a hire purchase. Okay, you just pay over 12 months only. That's all. Okay, now that's it. So based on this, you calculate for me what are the 4 assets. Okay, the 4 note note 2 to note 5. How much is the qualifying expenditure, and how much is the allowance? I only want the allowance for 2012. 2011 don't need to calculate. And I didn't ask for RE. That's why you don't have to start from the beginning one. Okay, you just straight away calculate for me the amount for 2012. Okay, try this. Okay, so to guide you, I'll put down all the assets. Motor car 1. Sorry, delivery truck you lease, you don't need to buy one, you got no CA. Motor car 2. CCTV and the filing shelf. That's it. Show QP, okay, show QP, and show for YA2012 if you're gonna get initial and no allowance. So you fill in the 12 numbers, then you get 9 marks. Okay, fill in correctly, you get 9 marks. Okay, the car number 1 is non-commercial, right? So if it's non-commercial, the value now they say is 240. So what is the amount you're going to use? 50. Okay? Okay, car number 2 is also non-commercial. It's a new car, cash 148. So maximum is 100. Okay? CCTV 1950. And this
那么他讲到摩托卡是否可以定点测试？还是用
no. You use for trading business doesn't mean that it's just a car. It's used in the business. That means I give you as a worker, you drive. It's also called use in the business. So you must see that they mention commercial use, or they mention like it's for transportation of goods or passenger. Then only it can be commercial vehicle. If not, then generally as a car it will not be commercial. Okay. Now the filing shelf is 690 each. So what's so special about this filing shelf? It's a small value asset. Okay. So the QP is 690. Okay. So this motor car 2012 now is the 2nd year. Am I right? So got IA or not? No. You just claim AA, right? 10,000. Okay, the second motor car you buy them in 2012, am I right? So do you get IA? Yes. So you get 20. Now CCTV. So a normal, the amount is 195, so it's not small. So a normal claim 20%, 390. So you wouldn't call it a plant, okay? So that's why we take a 10% rate on the other group, okay? So 1950, 195, okay? Because these are things very judgmental. I would think it's 14%. Okay, I would say that it's still plant and machinery, but the examiner say it's 10%. Okay, so we just follow 10%. But I think I remember that both rates are even credit if I'm not wrong. Now, filing shelf is a small value asset. So small value, what do? You claim 100%. It's not an annual allowance, it's a special allowance. So I think I put a note here, okay? So I put a note 6009 that small value asset is given a special allowance 100%. Okay, that's it. You just total up to get what's your total allowance. Finish. Okay, C. Okay, now they ask us in C, what is your income tax treatment on the payment made for the truck under the lease financing arrangement? So what's the treatment you have? Now first of all, the truck is on lease, not acquired, correct enough? So Jom Sendram Berhad does not own it. Now if you don't own something, you cannot claim CA, correct enough? So if it does not own it, you're not entitled to claim capital allowance. Instead, the lease rental is given as a tax deduction. So I told you already, you just say deduction is meaningless one, because deduction is what? Where do you deduct is important. You don't just say a deduction. Donation also you deduct, right? Loss also you deduct, right? So you cannot just say deduction. You must say where you deduct. And to tell where you deduct, you will have to identify which level. So it's given as a tax deduction against the business gross income in arriving at its adjusted income. So how much deduction that you will give for the amount here is 30 and 100, okay? So 30,000 deduction is available to the business income of the basis period for Y 2011, and then 100,000 for Y12. Now, is a delivery truck, so it's commercial, right? There's no restriction, right? Not? That's why the 30 and 100 you claim in full. If you lease a non-commercial vehicle, then you would have restricted, is it not? So that's why you must explain, right? That as a delivery truck is a commercial vehicle, there is no restriction imposed to the maximum deduction available. Okay, now turn to page 108. We look at part B, a short one, then we get a short one. Let's look at B first. Alright, now in B it says that Aziza 108. Okay, question 2. Now Aziza, a non-resident, will exercise employment in Malaysia as a teacher from 15 December 2012 to 15 February 2013. Now you look at this thing, okay? As a non-resident and your employment is from 15 December 2012 to 15 February 2013. You look at this. Is there anything that crossed your mind? What is it? Yes, 60 days rule. That's why you read the question more or less, you agak-agak, you know what they're going to ask you already. Unless you totally don't know what is 60 days rule, okay? Now, she will arrive in Malaysia on the 9th of December 2012 and she will leave on the 15th of April 2013 after 2 months holiday in Malaysia. Now, when we count 60 days, we count based on the employment, correct enough? You want to count for holiday, all that is not counted, okay? Now, she does not intend to visit Malaysia anytime in the remainder of 2013. Okay, Aziza expects to be paid 40,000 for the entire period as a lump sum on the commencement of the employment on the 15th December 2012. Now, she received everything at the beginning, okay? Everything. The 12 until 13, she take all the salary. Okay, there's no contributions to EPF. Okay, first of all, explain how the income tax treatment of the 40,000 in the hands of Aziza. Now we are asking you the income tax treatment. So first, if you talk about treatment, the first thing I think you must say is taxable or not taxable, right? Is it taxable? How do you know whether something is taxable or not taxable? Taxable or not taxable depends on what? What's the word? Derivation. Yes, derive or not. Okay? Now, income is subject to Malaysian tax if it is deemed to be derived from Malaysia. Okay, then is this employment income derived from Malaysia? Yes, right? Okay. Now, such 40,000 employment income is Malaysia derived as employment was exercised in Malaysia. So it is subject to Malaysian income tax. Okay, then the next thing. Okay, the next issue. The 40,000 entire lump sum paid when she started got issue or not? Is there an issue? What issue is that? Issue affecting the basis period, yes. Why? If I say 40,000 pay when she starts and 40,000 pay when she completes, what the difference is? 40,000 pay when you start means is what? Is what? 40,000 if you pay at the beginning. and 40,000 pay at the end. What issue? Receipt in advance already. Because you work for 12 and 13. 12 is 12, 13 is 13, correct or not? So the income for 12 you tax in 12 normally. Income for 13 you tax in 13. If you receive later, but now you receive everything in advance, means the portion for 2013 is received in advance. So once you receive in advance, what's the issue? You tax when you receive, right? Okay. So since the entire amount of 14,000 has been received in 2012, including the advance income for 2013 employment, then the entire income is assessed to tax in YA 2012. So the one for 2012 is receivable in 2012, but the one for 2013 is advance income. Okay? Right, then the next issue is she's a non-resident, right? So as a non-resident, she will be taxed at 26% without personal relief. So as a non-resident, she is assessed to tax at flat 26% on her chargeable income without entitlement to any personal deduction, which is relief, okay? Okay, so this is B number 1. Let's look at B number 2 here. Now, explain how Aziza may slightly amend her employment arrangement so that she can qualify for exemption. So let's see how the amendment can be. Okay, now you notice that 15 December to 15 February, how many days are there? Okay, December got 31 minus the 14, 17 days. Okay, January got 31, no? February got 15, no? So she worked for 63 days. Okay, now if she worked for 63 days, then the easier way to do it is what? We should reduce the employment. Okay, reduce the employment by 3 days. Now I think you have to say carefully that you have to reduce the employment by 3 days. Okay, either you start later or you stop earlier. Alright, then you will get exemption. Now please don't just say delay the employment. Because you delay means what? Push 3 days away. So you push 3 days away, then you end 3 days late also, right? Then it's still 63 days. So I think the better way of saying is you just mention that we should reduce the employment by 3 days. Okay? Now, currently, her employment period from 15 December to 15 February is 63 days, and she does not qualify for exemption if as a non-resident her employment exceeded 60 days in Malaysia. Now stress on that you must be a non-resident, okay, that it exceeded 63 days in Malaysia. So to entitle for exemption, she could propose to cut short her employment by 3 days so that it is 60 days in total. Okay, this is one way. The other way is you don't make it connected, no? Because the problem is you count the 60 days is from 2012 to 2013 because they're joined together So if you break it, then they are not considered as one period already, right? So you don't have to join because they are not overlapping. So alternatively, she can leave Malaysia on 31st December 2012 and return for another job in 2013. But you have to make the arrangement that is 2 jobs. That will be a bit more work administrative to make it as though that there are 2 assignments. That you come here, then you go away, then you come back again for another job. Then you will count as 2 separate jobs, okay? Then it will be 2 separate 60 days. Where she's given maximum 60 days employment in Malaysia for each 2012 and 2013. Alright, now the first way is more reasonable. Just cut it short, okay? Now they mentioned that she will stay for holiday, okay? The stay in Malaysia for holiday is irrelevant to determine the 60 days employment in Malaysia. So it doesn't matter, that one is okay. Alright? Okay, number 3. Now explain whether short-term employment is exemption for short-term employment is applicable to every individual. Huh? Do you think everyone? No, right? Who cannot get? Public entertainer, correct? Okay, now it's not available to non-resident public entertainer. What else? If you work for 60 days in Malaysia, do you get exemption? You all. If you work here in Malaysia for only 60 days, can you all get exemption? Cannot. Why? Huh? Why you all cannot get? Because? Yes, because you are resident. So, that's the answer, right? We ask you, is it applicable to every individual? So I ask you, is it applicable to you? You ask yourself, applicable to you or not? No, right? Why? Because you are a resident. So, not available to resident individual. Okay? Right, so that's the part B. Okay, 10 marks here. Right, we take a short break, come back, then we look at A again.